I'm Alan Kenny, Editorial Director with REIT.com, and we're in San Francisco for REITWorld 2013. Joining me for this edition of CEO Spotlight is Phil Hawkins, CEO of DCT Industrial Trust. So Phil, I know that DCT recently divested its Mexican operations. Can you tell us what was going on with that?
Yeah, it goes back to our view, our strategy of focusing our people and our capital on fewer markets and markets where we can make a difference. I've said for a while about Mexico in particular, go big or go home, meaning play to win, invest in people and land and infrastructure where we can make a competitive difference, or redeploy that capital elsewhere. And the investment required to be competitively significant in Mexico was substantial in both land and people. The opportunities in the U.S. were exciting, both with our people and our capital. And then as pricing improved pretty significantly over the last 12 months in Mexico, the trade-off became pretty straightforward for DCT. We like Mexico as a market, it just wasn't our strength, nor a strength that we felt our shareholders would benefit from us trying to develop. So we sold.
So then can we expect a primarily or exclusively U.S. focus for the near term? Or?
Not for the long term. Our focus is the U.S. For now a number of years, we've been repositioning the company and the portfolio to be in fewer markets. The intent is to remain in fewer markets, not to add to the list, certainly not to go outside the United States. Our expertise is the U.S. I think we benefit from that focus. And the opportunities in the U.S. are terrific. So we have no intention of broadening the footprint beyond where we are.
So let's talk about those opportunities. Where do you see them here in the United States?
Certainly right now, development is an exciting opportunity for us. We've spent a lot of time building the development capability and acquiring land at attractive prices that allow us to develop at really attractive risk-adjusted returns. Demand is strong. We're in a healthy leasing environment. We are able to deliver finished product that's brand new, Class A, at very attractive returns. And so that's been a bright spot. We continue to use our market teams to source acquisitions, particularly acquisitions with leasing or renovation opportunities to further improve the asset, and the risk-adjusted returns have been pretty attractive. Right now, I think the market is very focused on, in general, very focused on stabilized quality assets. If you can buy something that is under-leased or can be further improved physically through renovation and redevelopment, you have an opportunity to create real value, and that's where we've spent our time in addition to development.
In the last interview we did, you talked a lot about concerns with the supply-demand dynamics and the improving economy. Can you give us a little bit of an update on where things stand now, in your opinion?
I'm not sure I expressed concern, although I probably would have flagged it as something to watch. And clearly, it's always something to watch in our business. The supply has increased as markets have improved, in the markets where they've improved the most. So you're seeing construction in markets like Southern California, Houston, some in Pennsylvania, maybe as well, Seattle, South Florida, markets that are strong in terms of demand, rents are strong. I think you still want to watch it, but I'm optimistic, and I'm optimistic because of the way in which current development is being funded. It is not being funded by bank loans, non-recourse bank loans to fund land acquisitions or speculative construction. Is being funded by equity, either balance sheet equity of the developer itself, like the public REITs, or by institutional capital providing equity to private developers, but the equity is controlling the decisions. More disciplined in terms of starts and leasing. And I think that leads to a little more healthy environment than you might have seen pre-recession.
All right, well, thank you so much for the update, Phil.
Thank you.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.